Hi, my name is Joe Ovsenik. I'm President and CEO of P2 Gold Inc. I'm joined by Ken McNaughton, our Chief Exploration Officer today. Thanks for taking the time to hear about P2 Gold and our Gabbs project. I will be making forward-looking statements throughout this presentation. Now, at P2 Gold, our focus is on our Gabbs project, gold copper Gabbs project, located in Nevada. And so for this presentation, I'll give you a quick summary of the project, a little bit of background, some of the news that's recently come out that's quite exciting, and then we'll walk through our preliminary economic assessment results, and we'll wrap up with some comments on our plans to look ahead and news flow. So on that note, I'll move on to our summary of Gabbs. So if you take a look at the right, you can see on the project, there's our Gabbs project. There's three features of Gabbs that to me really stand out. First and foremost, we're in Nevada, a top tier mining jurisdiction, recently ranked number 2 in the world by the Fraser Institute. Next, infrastructure. We've got excellent infrastructure at Gabbs. We've got paved highway right to the project. When we fly to the project, we land in Reno. It's about a 2-hour drive away, and drive to the project on pavement. Hawthorne, which you see in the lower left-hand corner of the map, is where we have an office. It's about a 45-minute drive to the project, and that's where our crews stay. We have power right across the property. Historically, there was a water well permitted on the property, and we're in the process of re-permitting of that. And then thirdly, we've got a nice resource. Currently, it's about 3.5 million ounces of gold equivalent, about 2 million gold, 1.5 copper in the equivalent. But potential that we see to look for 4 to 5 million ounces near surface and far more potential at depth. So that's a quick look at Gabbs. Now, with all that going for it, you can ask, well, why isn't Gabbs just a hole in the ground? Why wasn't it mined out earlier on? Well, there was a lot of work done on Gabbs starting in the late 60s through to the mid 90s. And they really couldn't get the traction because at the time, Gabbs was marginal. And what Ken and I have learned over the years, we've worked together for a long time, is that once a project's marginal, it's always marginal unless there's something that changes. So you can get more tons, you can increase the grade, or there's some technological advance. And for Gabbs, there's a couple of things. When we picked up Gabbs, we could see there was potential for a lot more tons than were currently there. And that's what we're looking to expand on. But the real game changer for Gabbs was the development of the SART process in the late 90s. You can see that here on our timeline. Late 90s developed, first one in production in 2006 down at the Telfer mine in Australia. That's a fairly significant mine. And what a SART process does, it allows you, well, let me step back a bit. Prior to the development of the SART process, the issue for projects like Gabbs, where you're trying to have oxide mineralization, gold, copper oxide mineralization, and you're trying to heap leach it, the copper goes in, gets dissolved by the cyanide, builds up in solution. So you use extra cyanide, and it also interferes with your recovery of gold. So what it does is it makes the project uneconomic. Now, with the development of the SART process, what it does is it allows you to recover the copper, recycle the cyanide, and then recover the gold. So that allows you to improve the economics of the project, and that's what allowing Gabbs to have the great economics that it does today. So if we look at what we've been doing of recent, we have a metallurgical program that we're just wrapping up. We put some news out just a couple of days ago, and we're going to run through that next. But before I get into that, quick word on the SART plant. So what SART stands for is sulfidization, acidification, recycling, and thickening. And so what it does is when you're heap leaching, what you do is you grind up your rock. In our case, we're grinding it up to about a 1/4 inch. We put it on a heap, so a pile. We then sprinkle a solution on it that contains cyanide. That solution's collected, and it gets run through the SART plant. And the SART plant, it comes into the SART plant, you add sulfur, and what you're doing is you're taking those oxide, copper, silver, and you're producing sulfides. You then add acid, which drops the pH way down to about 5. That precipitates out your copper and silver sulfides. And then you add lime, increase the pH up to about 11, and that gets your recycling of your cyanide. And then the solution is run through your ADR plant, the gold is extracted, and then it's barren solution and it's run back over the heap leach in a closed circuit. So that's just a little background on SART, and it's very important for us because that's the game changer that makes Gabbs a success. Now, if we look at our metallurgical program results we just announced, now these were all focused on the oxide, gold, copper, and there is a bit of silver. And so if you look at the right-hand column, you can see back from our PEA we completed in May 2024, those are our recoveries, 78% for gold, 45% for silver, and 54% for copper. Now, at the time we had to use these, we were trying to get our project, our PEA out. Ken wasn't comfortable with the numbers. He thought they were low based on other information he had on hand. So at the beginning of this year, we collected a 338 kilogram sample of mineralization from Gabbs, from the oxide. We had that, brought that to the lab, Capex Cassidy in Reno, and they ran a 150 kilo column test on that material. They also ran a column test of 15 kilo on some other material that we had. 45 kilo test on some other material we had. So what we've done is we've run those columns, and after 58 days, you can see the center column. We announced those results. And on the second from the left column, that's the recoveries that we just announced and what the market really seems to be appreciating. Because after 115 days, we see a significant increase in the gold recovery, the copper recovery, and quite a lot in the silver recovery, even though there's not a lot of silver. So those aren't final numbers. Capex has to then take the columns apart, re-assay things, back calculate and verify all the numbers. But we figure these numbers are close to where they're going to be. And so we're quite excited about this because for two reasons. One, big lift in the gold recovery, big lift in the copper recovery. And secondly, you can see by the middle column, or the 58-day column, most of the gold and a lot of the copper are coming out in the first 58 days. And that helps with your cash flow, and that helps with the size of leach pledge you need to move forward. So it does impact on your cash. So great results, and we're looking to build on those. So now let's turn to our May 2024 PEA. Now remember, these are based on the old recoveries for gold, copper, and silver. If you take a look at the spot case, I ran this yesterday just for this presentation, and you can see that's on the right-hand side of the screen. We're sitting at around 55% internal rate of return, NPV 5, $1.6 billion US dollars. And we run for ourselves, just to get a feel for things, we run it at NPV 15, so 15% discount. And we're still over 600 million in NPV. So there's a lot of value sitting here at Gabbs. Our base case, which is over a second from the left column, 1950 gold, 25 silver, 450 copper, you're still seeing a 21% rate of return. And these numbers should all improve with the new recoveries when we update the PEA. So taking a look at our circuit, I already talked a little bit about this, but for the first 5 years, we're going to be mining 9 million tons of ore a year. That'll be placed on a heap. We'll leach it. We run it through the SART plant. Then we run it through a gold recovery plant. That's an ADR plant. And then we produce gold doré and copper concentrate. This year 6 through 14.2, we add in a mill. So in year 6, we keep heap leaching, but only 4 million tons a year. So we back it off. And we start up a mill at 5 million tons per year where we produce a copper flotation con and gold doré from leaching the tails. Now recoveries...
Just to clarify, it's the oxide material goes to heap leach, and the sulfide material, as the pits get deeper, we get into the sulfide mineralization, that goes to the mill.
Exactly. Thanks, Ken. And so the recoveries on the sulfides, you can see at the lower part of the screen, we have a lot of work on this. We've done some in our phase 1 metallurgy trials to confirm historical work. but there was a lot of historical work done on the project regarding flotation. So gold at 94.5% and copper at pretty much 80% are solid numbers on the milling. If we look at gold production, left-hand side of the screen, that's life of mine gold production. Right now, we're looking at about 1.47 million ounces of gold produced over the 14.2 years. I would expect with the enhanced recoveries, that should bump up into, say, 1.55 million ounces of gold, somewhere in that range over life of mine. Copper, we're sitting at 190,000 tons of copper metal, and that should bump up with new recoveries to 200 to 210,000, somewhere in there, tons of copper metal. Silver, again, it helps. Every little bit helps. 2 million ounces is nothing to sneeze at, but it's a small part of our production. But even with the new recoveries, that should have a significant improvement because of the big jump in recoveries. And so you should probably see closer to 3 million ounces life of mine. Looking over on the right-hand side of the screen, we're producing on average over the 14.2 years, 104,000 ounces of gold, 13,500 tons of copper, and about 145,000 ounces of silver. And as I mentioned, these numbers should all bump up with the enhanced recoveries from our latest metallurgical test work. If we look at those on a year-by-year basis, you can see gold, copper, silver, and that little mark on the top there. So at base, this chart was put together at base case metal prices. So at base case metal prices, copper is ranging from 25% to up to 40% of our cash flow at times, close to 40%. At spot prices, because gold has increased significantly in the last 6 months, gold now really dominates, and copper contributes 10 to 20% of our cash flow. So these charts would change a lot based on that. The other thing you can notice is we've got a bit of a lull in production here as we get moving along through our oxides. One thing we'll talk about is expanding the oxides with a drill program later this year, and we'll look to increase the amount of oxide, higher grade oxide available for leaching during this period, which will help the cash flows. So if you look at Gabbs in context of Nevada, there's some big gold mines in Nevada. You've got, Barrick and Newmont have their joint venture. But once you get through a couple of the big mines, if you looked at production in 2024, you can see that Gabbs would be about the 4th largest gold producer as a standalone gold mine. And as a standalone copper mine, it would be the 3rd largest copper mine. So that's significant presence. So you put the two together, you have a nice size gold copper mine in the heart of Nevada. Now, if we look at our Capex costs, we're right now, pre-production capital is about $365 million. That's to get the heap leach up and running. Once we're in production, in year 6, the mill comes on, and that's why you see total production capital costs, that's sustaining capital and mill capital. So mill capital is $343 million to build that 5 million ton per year mill. Now, the way we envision this when we first did our base case metal prices, we start up the first 3 years, pre-production capital is paid back. Year 4 and 5, we're in construction, but we're still producing heap leach, so that's paying for construction. And then the mill is completely paid off about halfway through our first year of production out of the mill. Now with spot metal prices, the pre-production capital is paid off in the first year, and the mill and all the rest of the capital is paid off by year 3. So it really does show the robustness of the economics and the leverage to the price of gold. Operating costs, typical for Nevada. I guess you can see our mining costs, $1.55 per ton mined. That includes rehandling costs. If you take the rehandling out, that's around $1.65 per ton, which is in line with what you'd see at other operations. Our heap leach processing costs are a little higher, probably about $4 a ton higher than you'd see elsewhere in Nevada, and that's to take into account the SART plant. So moving on, there's A lot of opportunities to improve the preliminary economic assessment. We're not looking at a lot of those right now. We're going to take our time and look at those during feasibility. But as you can see, the top one here was metallurgy, and that will be used in a PEA update. And we are, as I said, great results, and we're looking forward to seeing how the PEA looks with those results in it. Quick look at our resource. This is the just under 3.5 million ounces of gold equivalent in all categories. It's made up of roughly 2 million ounces, you can see in the center, of gold, and roughly 1.5 million ounces of gold equivalent, predominantly out of the copper, a little bit from silver is not even taken into account into coming up with this number because it's so small. Now, what I talked about, and I think what we should emphasize is these numbers aren't static. There is lots of potential for increased gold and copper recovery. There's the 4 known zones outcrop to surface. That's how they were discovered. They're all open for expansion. There are other blind targets that we have indications of that we want to drill. And even these zones, some of the higher grade areas of these zones, we believe we can expand on. So lots of potential to grow this resource. And that's why we're comfortable with an arm wave of, say, 4 to 5 million ounces of gold equivalent at Gabbs or more. And that's at near surface. Here's an aerial view on the right-hand side of the screen showing our Gabbs property outline. That's the border of our mineral claims in red. You can see Sullivan, Lucky Strike, Gold Ledge. These are all gold copper mineralization. Sullivan has the bulk of the resource currently. About out of that 3.5 million ounces, but over 2 million of that is coming out of Sullivan. Lots of room for expansion on these others. And then Carbody is a small epithermal gold deposit, about 100,000 ounces of gold at around a gram, just under a gram of gold per ton. So look at it adds a lot of cash flow, but it's a small deposit. So the real focus for us are these 3 deposits and expanding them to really get to that 4 to 5 million ounce target at Gabbs. Now, our plans for this year, we're in the process of re-permitting our water. So we expect to get our water permit in not far off and not too far distant future. So that's some news coming out. We'll get our final metallurgical test results. We're pushing hard to get those results by the early part of September. So if successful, we'll have final metallurgy results out in early September. With those results, we're going to update the preliminary economic assessment. We're going to push hard on that and try to get that out earlier in September, but we'll get it out in September one way or the other. Later on in October, we want to get some expansion drill program going. And so we'll have drilling going on, and so we'll have news flow going through the remainder of the year. And we expect to have some pretty good drill results from where we're going to be drilling. Baseline's always environmental baseline's always an ongoing item. And then finally, we'd like to get our mining plan of operations filed with the BLM, and that kicks off our permitting process for production. Might be a little tight for year end, but we'll push hard on that as well. So that's a quick run through of our Gabbs project. Here's what it looks like. This is I'm standing on Lucky Strike, looking to the north. Great place to build a mine. Lots of room for facilities. Our heaps go in here. The mill goes down here. Lots of room for lay down during construction. Yeah, you couldn't find a better place to build a mine. It really is. It's a sweet spot. Here's our schedule for production. Right now, we're showing production in 2028. Now, there's a chance we can pull this forward a bit if things go our way. I wouldn't say 2027, but earlier on in 2028. It's still viable, but time's moving here. It's getting on in 2025. Here's our team. As I mentioned, Ken and I have worked together since the mid-90s at Silver Standard. Michelle joined us at Silver Standard in about 2004. So we've worked together, so 20 years now with Michelle involved. Grant's the young guy here. He's been with us about 8-9 years. So we're a good, solid team. We've had a lot of successes with Camplat, Silver Standard, Pretium, and we're looking to make P2 a big success for us. Here's a little look at our cap structure. Our market cap July 31 was about 19 million Canadian. We've had a nice bump up in that in the last few days based on our Met results. Cash at the end of June, our last financials, 1 million and change, and issued outstanding 152 million. Now, if you look at the makeup, most of our shareholders are retail shareholders, but management has 23%. That's predominantly Ken and I, and we've got about $9-10 million into this project, and are believers and well incentivized on that front. And Waterton's the outfit that we bought the project off of at 15%. So as a sum up, that's Gabbs. We're quite excited about moving it forward. We expect to get some good momentum going into this fall, which will carry through into next year and push towards production. So that's P2 goal. And happy to answer any questions you have from here on.
Thank you for an excellent presentation. So maybe I would like to start with you and Ken. You could choose who starts. Could you tell us who you are and tell us about your career?
You go.
Okay, I'll go. Well, geez, it's not
before brains, right?
Well, that's a stretch. But my background is I'm a mechanical engineer to start with. And what got me into mining, I worked a summer when I was in mechanical engineering up at the Grand Duke mine, Golden Triangle. And I really fell in love with that area. Like, I lived in Stewart and I just loved it. So when I came out of mechanical engineering, worked as a mechanical engineer for a few years, went back to law school, came out of law school. And after working for a while, mining stuff, I joined Silver Standard Resources. Ken was already there. I joined about mid-90s. And that's where we really started to get some traction. We took that company. We were sort of key lieutenants in the company. Bob Quarterman was our president. And we took that from about a 50 million market cap in the mid-90s up to a couple billion in 2010. And at the same time, we accumulated between various projects, either acquisitions or discoveries, up to 2 billion ounces of over 2 billion ounces of silver in the ground. And we had a producing mine up in the Andes in Argentina. So it really taught us a lot. We saw a lot of projects. Ken's projects he's looked at over the years. But we really learned a lot about what's out there, what it takes to make a successful mine while at Silver Standard. We started up Pretium in late 2010. And I started off as Chief Development Officer. I moved on to President and then CEO. We had a great time, had a lot of success. We're really proud of our achievements there. We took it from Ken's discovery hole back in 2009 to commercial production in June of 2017. So under 8 years from discovery hole to production in British Columbia. So we feel that's quite a feat. So that's my background.
Well, mine's very similar to Joe's. I've got a couple of degrees in geological engineering and worked for a number of years, mostly on exploration projects, but some advanced exploration projects that were in feasibility. So on the technical team for Mount Poly, Mount Milligan, Nickel Plate Mine, all producers now, and then went to work at Silver Standard ahead of Joe. And when we took on the silver focus, as Joe mentioned, we went from no silver resources up to well over 2 billion. But we also found a number of mines that are either now in feasibility or are producers. So not just Pirquitas in northern Argentina, which Silver Standard actually developed, but we developed the Manantial Espejo, which Pan American bought, San Agustin, which Argonaut bought. Through Canplats, we found Camino Rojo, which is now in production by Orla. So, we have developed a team that not only found a lot of resources, those projects became mines. And my role in that was not just the exploration, but also all the early engineering. So basically, I run the projects, including all the technical work, up to the point of pre-feas, feasibility, and then we need a more substantial team. So we up from there. And then, as Joe said, Silver Standard, we left there, went into Pretium. And, we took that from nothing and, outhouses and tents to building the mine, doing an underground development program, long power line. We in the exploration group built the road. So that was 75 kilometers. So, we do a lot more than just drill on the technical side. So between Joe's management and my technical abilities, we think P2 is ready to just keep rolling.
Awesome. Well, let's talk about P2. So, could you walk us through the history of P2 Gold? How did you get started, and what have you done up to now?
Well, we came out of Pretium and we were looking for something to do, so we took on a company. We were kind of itchy with some COVID. We wanted to do something, so we took on another company that was existing, Central Timmins Exploration, and it was a shell, and we changed the name to P2 Gold. At the time, it was in COVID. If you remember, gold had a bit of a surge up at the beginning of COVID, and so the price of projects with resources really went through the roof. And so we picked up some exploration stage projects. But we're always on the hunt for a project with resources. So we started exploring on about 4 or 5 projects. And then in 2021, gold seemed to roll a bit. So guys got a little more reasonable with pricing, not overly reasonable, but a little more reasonable on price. And we bought Gabbs off Waterton Resources. So Waterton Precious Metals, I should say. So that filled up the stable. We then continued. We dropped a few of the projects. We kept one, the BAM project up in the Golden Triangle, drilled that. But, the cost of operating in the Golden Triangle with a junior without, Ken and I were doing a lot of the funding of the company. And it's very expensive to operate in the Golden Triangle because everything is helicopter supported. So you take whatever your exploration costs are and you double them to pay for the helicopter. So what we did is we thought, look, P2, we're just going to dilute down all the shareholders if we keep banging our heads at and exploring in the Golden Triangle. Let's get focused back on Gabbs. We had worked on Gabbs early on, but we'd set it aside when the inflation was rampaging and we were worried about inflation settling down so we could get a decent Capex number that wasn't going to be out of date within, a few days of putting it out. So we did, brought Gabbs back along, inflation tamed down, and we've been able to push Gabbs along. We came out with a PEA in 2023 just to test things. We came out in 24 with a more robust PEA, which is the one we just walked through. And we think is a really good blueprint for a mine. So that's sort of the genesis of P2, exploring and Gabbs and focusing on Gabbs now.
So let's move back to the shareholder structure. I mean, you showcased it quite well, but so let's talk about Waterton, which is a private equity group. They own 15.5% as showed. So, and this obviously creates a bit of an overhang because they can't sell in the market. They have to file that. So I guess first of all, do they want to sell or are they a long-term shareholder? Just to clarify that.
Waterton's a fund that is the head guy that started up the fund is retiring, getting out of the business, and so they are winding up that fund. That's from what we've been told, and we've had lots of discussions. So they are winding up that fund. So look. They do want to sell, but they realize, look, we can't sell in the market. We have to file insider reports. As soon as people know we're selling, it's a lot of stock. It's too much of an overhang. So what they're waiting for is someone to come to them with an offer to buy their block of stock. And so we've had some discussions with some people about coming in, and that's an ongoing thing we're looking at. And as we move up, we'll see who's out there to buy their block of stock. They're not, like I say, they're not going to blow it out in the market. So it is an overhang, but it's going to be dealt with through a block sale to what we think potentially would be a strategic investor or something.
Do you think it will likely that will be one group that take maybe not all, but at least the majority of their block?
Yeah, I think that's the way it'll eventually roll. We'll set it up best we can.
Do you see this as something that probably will get resolved within the coming 12 months?
Hard to predict, but yes, I'd say we're optimistic about getting resolved in in a shorter time.
Awesome. And you have 49 million warrant outs. Could you roughly, obviously there are various the expiry dates and exercise price on them, but could you give some outline, especially on the larger blocks of warrants?
Yeah, look, the first chunk of those warrants, there's about 23 million, 24 million that are due in February through March, various dates, February through March of this coming year, and they're at 15 cents. And then there's another 20 million that come due next fall, next September, just over a year from now, and those are at a dime. And the 15-cent ones were all part of an issue that we had debt owing to Waterton coming out of the initial acquisition, and as part of settling out that debt, the market the nice thing about a bad market is that even the vendors realize the market's bad and they're willing to take a haircut on their price. So we were able to get quite a reduction in the debt that we owed Waterton in order to just pay them out and close off the acquisition. So we did that early in 2024, and that's where about 25 million of those warrants come out.
Okay, but so in other words, I mean, as long as the price stays, healthy above 15 cents, you could get probably up to, $3 million, end of Q2 next year.
Yeah, in the Q2 next year, it's probably close to $4 million would come out of those warrants.
Yeah, and also, so the debt, that will also, that convertible debenture, that will be converted most likely to shares by, was it January, end of January next year?
It's March. Well, yeah, it expires, January 31. We issued it in March, but it expires January 31 of 2026. Conversion price is a dime. We've had a bit of conversion lately, so there's about 1.17 million Canadian outstanding right now on that convert, and we would expect all those to convert. Look, if we have the cash, we'll look to buy it back. But if I was I've already converted. I had converted, and I already converted it. But if I was still holding it, I'd convert. Would let it be bought.
Okay, but that's good. Then we've cleared up the financial position. 1.1 million, give or take, in treasury. What's the burn rate per month if you include everything, holding costs, G&A, everything besides variable exploration costs?
Okay, so our just G&A, keeping the lights on and things going, is about 20 grand a month Canadian, and then we have a one-time payment annually to keep the project in good standing down in Nevada, and that's, I think, $105,000. So you put that all together, what does it work out to? Maybe $30,000 a month, maybe a bit more, depending on the Canadian exchange rate.
And that's it.
Yeah, pretty low, but we're not paying ourselves.
Yeah,
that showcases, because that's, I mean, most juniors are around, I would say, $80 to $100,000 a month with G&A.
Yeah, we're accruing salaries for ourselves, and what we'll probably do is when we get the share price up to a reasonable, a lot higher than where we are today, we'll probably look to convert it into stock.
You mentioned drilling costs aren't cheap in the Golden Triangle, but they aren't cheap either in Nevada. So what's the all-in drilling cost ballpark per meter here for RC and Diamond?
RC is around 250 to 300. There's some variability in there for water and things like that. Diamond drilling is, we had a very expensive contractor. It is the only drill available. So, I mean, our numbers back then were 600 a meter, but that was a crazy number in the middle of COVID.
2021.
Yeah. So I'd expect diamond costs to be 400, 450. But we could work to do that lower.
That is US dollars.
Yes.
And now you're including assay cost too, or just?
Oh, assay, geologists, everything. Yeah.
Let's actually go to talk about Gabbs. So, could you walk us through the geologic setting of Gabbs, and also now also if you look out a bit regionally?
Well, I'm not. Well, regionally, we're sitting in the Walker Lane trend, and the deposits. Well, we're not typically Walker Lane trend, although we're Walker Lane like, because our mineralization is actually older than Walker Lane. the best comparison might be Paradise Peak, which is immediately adjacent to us on the south. And there in the 90s, Dick Silito wrote a paper on it, and he believed that was the top of a porphyry system which had been decapitated. So Paradise Peak was the high sulfidation silver plus some gold system from a porphyry system. And that analogy has been stretched onto Gabbs, although work by a number of others suggests maybe perhaps not a decapitated porphyry. But, in short, we had our basement rocks are older, shallow marine sediments. They're Triassic in age. And then we have Jurassic, Cretaceous volcanics laid on top of those. So these are all mafic to ultramafic volcanics, andesites going into gabbros. And then, as I say, the interpretation by Newcrest and a couple of others is that rather than thrust wedges, these are actually intrusions of monzonite. And again, it's a mafic-rich monzonite, and that's come in along the contact between the andesites and the gabbros, the overlying gabbros. And then at some point, the mineralization was introduced. It's dominantly concentrated within the monzonite. So the gold mineralization is very tight within the monzonite. We sometimes see a little bit bleeding up into the overlying gabbro, but it's usually dead. And then the gold attenuates relatively quickly as we move out of the monzonites and go into the footwall andesites. Copper mineralization is more widely spread. And again, it rarely goes up into the gabbros, but we see a pretty consistent 0.3, 0.4, 0.45 through the monzonite, and then dropping off much slower as we go down into the andesite. So you have a much bigger copper halo as opposed to the gold mineralization. And so there is some structural components within all of that. We're still understanding the structure at Sullivan. There's a structure that cuts off the zone along the northeast contact. We believe that was actually active during mineralization and then reactivated to offset the zone. And then certainly if we go down to Lucky Strike, there seems to be more structurally complex with a lot of mineralization forming high-grade feeders that we see on surface, a lot of historical mines. But where those structures cross a monzonite, we see big blowouts of mineralization, and we see the more bedded mineralization similar to Sullivan. And then down at Carbody, that's a low sulfidation, just a quartz carbonate breccia that's chaotic and infilled with just gold. There's no copper down.
So if you focus on Lucky Strike and Sullivan, which I don't know, I guess 85% of the gold equivalent ounces sit or somewhere around that.
Yeah, that's right.
The majority, at least, yeah. So first of all, how does Lucky Strike and Sullivan differ from each other?
Well, the difference is Sullivan seems to be more intact. We've got this tabular body of monzonite, which outcrops. That's where we took our bulk sample or sample from for the met work. It's pretty benign in terms of predicting where it is, and it's still open. As Joe mentioned, we haven't drilled the up dip slide yet. We kind of went down dip looking at extending the mineralization to depth, but we didn't have time to get to the up dip side, moving up to that bounding fault. So there's a lot of potential to find more high grade and increase our grade in tons at Sullivan. And then there's some offset things that we're going to test with the next program. As I say, over at Lucky Strike, it appears to have been more disrupted. So there's been a bit more tectonics. The blocks have been moved up and down a lot more. And so what we need to do is come in along the structures and where this, and we've got some historical drilling to guide us, so we're not just shooting in the dark. We need to move along these structures, get them well defined, and then drill to define where the monzonite is. And that's going to be our high grade zones. And again, the same relationship with gold dominantly in the monzonite, attenuating as we go down into the andesites, and then the copper halo is bigger. But it seems to be more associated with these subvertical structures.
All in all, is the mineralization itself, at least the majority of it, intrusion hosted? So in the monzonite?
Yes, on the gold.
And copper?
The copper seems to be a broader halo, and there's no supergene enrichment. This is a very low sulfide system, so the copper doesn't seem to move very much. That distribution of the copper and gold we're seeing seems to be primary, but the oxides are still in place. The gold is associated, in the monzonites, the gold is associated with a quartz carbonate stockwork. And so the gold and copper were likely separate systems, which is relatively typical in a porphyry setting and other settings, but we still believe we're in a porphyry setting. So in my mind, I think the monzonite is a little more brittle than the volcanics, and the gabbros are just not reactive, and so nothing went up into the gabbros. So the monzonite, there is a structural component with this stockwork, and the gold came in with that stockwork system, which didn't extend into the andesites as well, but the copper is more of a hydrothermal system, and they came in likely closely timed, but they're separate systems.
Is there zones where there are high grade copper, high grade gold, or are there some kind of zonation at either of the two main deposits?
No. The zonation is more stratigraphic. So when you're in the monzonites, we're typically seeing golds in the plus gram range, and the coppers in the 0.3 to 0.5, but 0.3 to 0.4 ish. And then as we move out of the monzonites, as I say, the gold attenuates relatively quickly. It goes from plus a gram to half a gram for 10, 20 meters, a quarter gram, 0.1 gram. So within 50 meters of the monzonite, the golds are relatively low, but the copper can go, up to several hundred meters from the monzonite.
All in all, you would call it that this is a porphyry.
Yeah, no, exactly. It's definitely, just brushing up on it. I mean, it's clearly porphyritic, the monzonites. So and all of the and the monzonites came up in several phases, so you could see the distillation of the porphyry. There is a parent porphyry somewhere, and the distillation of that porphyry was showing up in the quartz content and the porphyritic textures as these dikes and sills evolved. So there's no question we're in a porphyry system, but it appears that the porphyry is going to be off to the side somewhere feeding this system.
Okay, and that's can you see that with the mag data, or where potential feeder would be?
No, for sure. There's mag data. Newcrest identified an area with some deep looking IP, which coincides with some of the MT work that we did. So there's a lot of evidence for the parent porphyry being not too far away. It's beyond the scope of what we're looking for. Our focus is that near surface mineralization, define those bodies. Let's get an economic deposit going. Let's get into construction, and then we'll have the money to go and start drilling 500, 600, 700 meter holes looking for the porphyry.
Yeah, no, I fully agree on that. I mean, you already have almost 3.5 million ounces, so there's no shortage on that. By the way, where does the oxidation, when the sort of the sulfide zone start, and is there a larger transitional zone, or is it does quite quickly transition into sulfides?
Yeah, we use the sulfur content to define that, and 0.1 sulfur is kind of our benchmark. And typically the sulfurs are in the sulfide zones are only 0.5%. Sometimes they go up to 1%. As I say, it's a very low sulfide system. So it's Sullivan, the oxidation's a little deeper. It's between 100 and 150 meters from surface. At Lucky Strike, it's a bit shallower. It's 60 to 80 meters.
You mentioned among other words, drilling up dip. Which one is, according to you, the best way to expand Gabbs?
Well, definitely finish the drilling at Sullivan, because when Joe and I took the project on, it only had 1.7 million ounces equivalent. So with two 4,000 meter drill campaigns, we expanded that, almost double. And then, and also we've got a lot in the indicated category. So I think the best bang for the buck for us is to focus on that up dip trend at Sullivan, because we are moving closer to a structure which I believe was part of the mineralizing system. So we're seeing grades kind of getting better as we go there. Well, those grades aren't in our model right now. And then over to Lucky Strike. I think there's lots of room to expand Lucky Strike, and just keeping it within the context of a current pit. So we're not talking about trying to take this to 10 million ounces or anything like that. We just in the drilling required to get everything to measured and indicated, which we need for feasibility, we'll be able to get to the 4 to 5 million ounces without doing any step out drilling.
So essentially here, how much drilling do you need to do to get the feasibility stage at a minimum, and also how much would you like to do?
Well, for me, likely on the order of 10 to 15,000 meters of infill drilling. We need to do some more met work, so we'll need diamond drilling for that. We have to do metallurgy over at Lucky Strike. I'm not expecting anything different. Geologically, it's all the same, but we still have to do that work. So we need core for that. We need core for the geotech work on the pit. So 10, 12,000 meters of RC drilling, another 3, maybe 5,000 meters of diamond drilling. So, we're not talking gigantic programs of hundreds of thousands of meters. It's our cost to development is very well defined. Just sticking with what we've got and not doing anything else.
Let's call it 15,000 meters. Does that include more, sort of near mine, the expansion? So, for example, drilling up dip at Sullivan, does that include that more expansionary drilling?
Well, we need that for the indicated, so yes.
But we're planning on, like, the way I look at it, we've got that 15,000 meters roughly as part of the feasibility. We'd like to get that up dip drilling and all that done this year as sort of, roughly 1,000 meters, get that done this year. And then, we'll look at the feasibility drilling as a separate block.
Yeah. But
it's
all part of it.
Yeah, it all adds up.
When we do that drilling, that gets us more indicated, and yes.
So how much drilling would you like to do this year?
Well, everything's budget driven. If money was no object, we wouldn't have stopped drilling. But I think realistically we can get a few thousand meters in this year if money comes available.
But target would be roughly where we have targets right now that we really want to get that up dip drilling done.
Yeah.
It's less than 1,000 meters.
Yeah.
I guess now with the mountain drilling that you don't really need the oriented core or to see.
There's no value. The only oriented core we'll do is for geotech work on the pit walls.
I mean, you want to expand Gabbs to, let's call it for simplicity, 4 million ounces to be conservative. But this will not be at the expense of delaying
No.
a feasibility study at Gabbs.
We think that 4 million ounces will just come out of the infill and definition drilling that we need for feasibility.
And it's also why we like to do a PEA fairly early on in the project, just because you can drill forever, but if it ain't economic, why do it, right? And so we like to see what the economics are before we go keep pushing the drilling.
By the way, finally, is winter here an issue when it comes to drilling? If you're going to start later this fall?
No. I mean, the drillers, in Nevada, the drillers typically go away in December and they come back late January. So, but, if you had to work there, you could easily work year round. You might just have grumpy drillers around the holidays, but otherwise it's not an issue.
The weather, there's very little snow.
Yeah.
And when it freezes through the day, like overnight, we're usually positive through the day. So
yeah.
It's a nice place to work. It's not like the Triangle. It's nothing like the Triangle.
Yeah, you know that. And so roughly, could you also fill us in, how does the mine sequence look like with regards to timing of mining your deposits, Sullivan, Lucky Strike, Carbide, etc.?
Yeah, to start with, what we're going to get into Sullivan and Carbide, and then that's in the pre-production, start stockpiling. Sullivan, it's a lot of resource. So Sullivan's running pretty much constantly through the first 10 years. Carbide, you're chewed up in the first year, 2 years of mining. Gold Ledge will come on in I think year 2 for a few years. Not much. There's not a lot there yet. There's lots of potential for more, but at this stage, it's not that much. And then Lucky Strike comes on. It's got the bigger strip, so it comes on I think in year 2 and runs through the mine life, the various parts of it.
In year 4 and 5, according to PEA, you will have 330 million USD of capex. A lot of that is to build the mill, the sulfide plant. Do you expect the cash flows that will come out in year 1, 2, 3, and also year 4 and 5 that should handsomely pay for that?
Yeah. Look, at 1950 gold, there was a bit of capex that wasn't paid off till partway through the first year of mill production, but we would just use a revolving line of credit or something for that. We wouldn't be issuing equity to fund that.
Taxation in the US and Nevada, how does it work?
Well, no state tax, but we have our corporate tax down there, which they keep changing, but whatever it is right now, I think it's 22. And then there's some royalties on the project. So, so you're paying in those royalties.
Government royalties.
Yeah, sorry, federal government royalties, BLM. And pardon me, state royalties on BLM land is what I'm trying to say. And so those royalties kick in, and then you're paying tax there. But it's the income tax as you start producing a lot of income. You're even with no state tax, you're paying more and more.
And what's the royalty rate, give or take? And is it variable?
Yeah, it's variable, and it's not big. Off the top of my head, it's less than 0.1.
And the royalties, other royalties, what royalties do you have on Gabbs?
Well, when we bought the project, we issued we granted a royalty to Waterton of 2%, a 2% NSR. We reserve the right, so it's fully callable. So we can buy it back at any time for $1 million US for the first 1%, and 1.5 million for the first 1%, and $5 million for the second 1%. So for 6.5 million US dollars, we can buy back that royalty. Now, Waterton sold it off to Franco-Nevada, so they're holding it, but we have the right to buy it back. We don't really, because it's a fixed cost, we just see that as part of our startup cost. So when the mine starts up and we start cash flowing, we would buy back that royalty at 6.5%. $6.5 million for the 2%.
And
are there any other royalties?
There's no underlying royalties. Otherwise.
Yeah, maybe you could add some more color, especially on the flow sheet for the heap leach.
On the flow sheet, well, it's a 9 million to start with. We're 25,000 tons a day, essentially going on the heap. We have 3-stage crushing.
Are you crushing this material?
Yeah, 3-stage crushing. So a gyro crusher to start. We're going to probably change that when we go to feasibility, but for now it's a gyro to start, then a couple of cone crushers for the secondary, and then the high pressure grinding rollers for the tertiary crushing. And that gets us down to about a 1/4 inch. Then it's on the heap leach.
Agglomeration.
We use about, I forget how much, 100 tons of cement. I think we average about 68 tons of cement a day when we're running. So it's, for agglomeration. And then it goes on the heap after it's agglomerated. Then we use our cyanide solution.
Yeah, 145-day leach cycle, but as we showed, we'll get roughly 90% of the metal value out in the first 60 days.
Yeah. I think we'll be able to shorten that leach cycle because we got most of our metal out in 115 days. So the nice thing about that is you're not going to stack material on top of it till you finish the leach cycle. So because of that, you've got a certain size. I think we're about 1.5 kilometers of leach pad by the end of the mine life. Now that might be able to shrink down a bit by dropping that leach cycle from say 145 days down to 120 or something.
By the way, the silver will that be in the gold doré bars or will that be in the copper concentrate?
A lot of it falls out in the SART plant. So you'll see a bit in the doré, but most of it's going to come out in the SART plant.
Yeah, with the copper cost.
Awesome. And roughly what payabilities do you expect to get on your copper in the concentrate?
It's hard to say right now. We have numbers that we've used from comps that are out there that our engineering firm use that we don't really talk about, but they've taken them from other mines they've worked on. And so we'll go out and market ourselves. We've already had, expressions of interest on the SARTCon, mostly from traders. The traders like the SARTCon, I think, because you can blend it easily with your with other cons, get the grade up, so you get better payables. So that's where we're at. So we're not really talking payables yet, but we've got lots of interest in the product.
I mean, are we talking 70 to 80 or 80 to 90% or?
Well, right now, if you look at this, in the last little bit, there's this big demand for copper cons. And so your payables are way, way up. Now, I don't think those things are going to stay there. So, but we should get good payables, I would expect in the 90s. Because we will have some gold content especially in our flotation con. We're going to have a nice bit of gold sweetener in that con, which makes it more attractive.
Are there any significant amount of deleterious elements in your concentrate?
No, this is a pretty low sulfide system, so the arsenics are low. You have to look at the antimony, some of the others, but there's been no red flags in terms of toxic elements with the cons.
Yeah, it's a pretty clean con from what we've seen.
So speaking about your metallurgical results, did you do anything differently other than increasing the cyanide content to get? I mean, there's a quite substantial improvement if you compare to your PEA.
We added cyanide during the agglomeration. And then we were running initially 5 grams per liter cyanide. We went up to 10 grams per liter, but that's been the bulk of it. And we knew that from the initial test 2022, that the columns were starved of cyanide. So we just hit it really hard. And, our concern was that, we know that silver will reprecipitate as a copper cyanide if there's not enough cyanide to keep it in solution. And that mineral is not soluble. So once you precipitate it, it won't go out. We suspect that was happening with the copper. We didn't do any mineralogical work to find that out. But this time we had lots of free cyanide at the bottom of the columns. So it was no issue, and of course, the results speak for themselves. So cyanide addition, our cyanide consumptions went up only marginally, And that's based on the preliminary work. We still have to, there's still a lot of free cyanide in all the leach solutions that have to come out. So our cyanide consumptions, what we actually consume, have gone up perhaps a little bit, but our cyanide concentrations, we took from 1 gram per liter up to 10 grams per liter.
Perfect. And so in terms to get this to a feasibility stage, what are the next steps in terms of metallurgy, and now both for the oxide and sulfide material?
Well, I guess we're going to run, we will be running more columns on the oxide and refining the process there. We'll do some more flotation work, but there has been a lot of flotation work done historically, and by a number of well-named labs. Some are still around. Capex Cassidy has access to all that, has all that data because they actually worked on the ore back in the 80s.
Yeah.
So they have all their records. So there's a lot. So we've done some verification work on the flotation. We're comfortable with it, but we'll do more columns and we'll do more flotation work just to bed it in.
Not extensive, just to confirm our flow sheet and maybe a bit of optimization. But again, like the drilling, it's a well-defined, there's not a lot of unknowns. It's just, so for us to lay out a budget to get to feasibility, we can get there, we can estimate that budget pretty well within 10-15%.
Let's go to the PEA. The timing of that, is that updated PEA late September or?
Well, we'd like to say early September, but it's not really in our control. But we'll push hard to see if we can get it in early September. So yeah, that's the timing. It'll be September and as early as possible in September.
What new inputs are coming into the PEA?
Well, we're updating equipment costs, a lot of things like that. Where we don't have numbers, they'll inflate, like labor. They'll inflate it a bit, 3%, I believe. But a lot of the equipment costs, they're just updating equipment costs and input costs from data they have on hand from recent studies. So wherever possible, new data, new costing, and where we don't have access to easily get that new data, we'll just inflate it.
Yeah. Well, recoveries, but
and the recoveries.
But we're not touching the resource or the mine plan. We're just leaving that alone.
How much credit for the new metallurgical test works will be given in the new PEA?
Well, we're waiting on that. So, but we expect, right, if we're at 78% copper, 54%, 54% copper, 78% gold. Jeez. We're expecting mid-80s for gold, maybe a bit better. We'll see what final, after they do all the back calculating and everything else. And then copper, we'd like to see in the mid-60s. We'll see how that works.
Just to cap it off on the PEA, so there should be cost increases, but no material cost increases. If I'm hearing what you're saying, correct?
Yeah, from our perspective, the recoveries will far exceed the cost increases. So our economics will improve.
Perfect. And so the next step really is to do a feasibility study. We could start here. What work, needs to be done? What do you have to do? And also add some color on when you at the latest, would like to have a feasibility study out.
Sure. Well, Ken will chime in, but on the drilling side, we have our infill drilling we already talked about, geotech drilling for the pits, but also for the leach pad locations, and where our plants go, a little bit of geotech. On the rock, there's been a lot of comminution work already, but we'll do a bit more of that just to confirm the existing data. After that, we already talked about metallurgy, and then it's engineering and really getting into speccing the equipment and design, a lot of which is already done in the PEA. It's a fairly robust PEA if you get a chance to read it. So it's more than just drive by. So it's just really expanding on and firming up everything in that PEA. I think the biggest component will be the infill drilling.
What do you expect the cost to be to produce a feasibility study? All in all, with drilling, metallurgical work, geotechnical work,
We're thinking in the 12 to 15 million US. to get that done.
And you mentioned a few. Maybe you could summarize the key sort of potential changes that could come into the feasibility study compared to this updated PEA.
Well,
resource expansion. I think resource expansion's the biggest thing that we can do, and then optimizing that. As Joe pointed out, we've got a low area in years 4 and 5 in terms of production, so you see where we can smooth that off a little bit. And then I think the metallurgies, it's pretty good. We might be able to squeeze a little more, but I think we're getting to the point where it's, is it worth doing a lot of work to push the recoveries, or, do you just get going and get that?
Yeah, and then there's some easy stuff. It's it adds up, but right now when you look at the plan of operations to move this forward, the pre-strip is all drill and blast, and if you look at the project, it's mostly sediment. So we think we can get in there with scrapers and just scrape it down to the ore, to the rock on the pre-strip rather than drill and blast. And if that's the case, that's a good size saving for us because you're just driving a scraper over it and then dumping, as opposed to drilling, blasting, and shoveling and hauling.
You also mentioned you might switch to contract mining. Would that
well, it seems it's probably the most common form of mining in Nevada, and there's a reason for it. It puts all the burden of the benefits are they're taking care of all the maintenance for your trucks, your shovels, and all that. And as well as the manpower, that's all there within their control. On the trade-off, and you get the benefit of a lower capex. On the other hand, your op costs are a bit higher. So there's a trade-off there, but there's a lot of benefit to contract mining, and contract mining is quite prevalent in Nevada. So, it probably lean that way once we get into it.
You might have mentioned it, but so maybe you could re-mention timing of a feasibility study. I mean, how long does it take to do the work? How long? Do you have some kind of timeline? You had it obviously in the presentation. So
we think the drilling is going to be probably the longest. The drilling and the metallurgy, because metallurgy can only go so fast. The drilling is going to take a little while, but those are the two big items, and so we can do a lot of the engineering on the mill facility. Well, we won't, we're going to focus on the heap first and the mill. All that engineering will get done on the process side while the drilling's going on and everything else. So a year and a half, maybe tighten it up a bit if we really push hard.
18 months, maybe 2 years. It's cash.
Try to bring it down.
Yeah,
we have a little more cash. We hit it with an extra drill. We push.
Yeah, well, like you said, get the geotech engineers in. So we're doing geotech drilling. We're doing, foundation work for the leach pads. If money's available, we can go quicker. But realistically, 18 months is a nice number to work with.
From now?
Well, when we start.
When we kick it off, and that's money dependent. So if all goes well, we're kicking it off in, within 3-4 months.
How long is the construction and also ramp up time here?
Well, construction's about a year. Might be able to tighten up because we can work all year. There's lots of lay down. It's really efficient for construction, but we think we can sort of compress things down to about a year on the construction side. Ramp up, we don't see any reason why it shouldn't be pretty fast. Shit happen. Pardon me. Things happen, and you have to deal with that. But looking at it from this point right now, it's a pretty simple operation. We're starting with just a straight heap leach. Getting the bugs out of the SART plant will be the initial issue, and the ADR plant for the recoveries. But the crushing and the grinding rollers and all that's all tried and true stuff. The drill and blast, tried and true. So the ramp up to tons per day should be pretty quick. And it's then just getting that process optimization. And I don't see that being a big time, like a quarter.
Technically speaking, what do you consider to be the greatest risk associated with Gabbs, if there is?
Technically, to me, I always think the biggest risk we're facing is cash to move us ahead. Technically, well, it's time, right? Time impacts everything, and so all your work that you're doing, but there's nothing technically that's novel or new about this project. We're trying to use tried and true technology throughout. So
it's milk toast.
I don't see
as projects go. It's milk toast.
Yeah, we don't have infrastructure issues. We don't have logistics issues. It's as I keep saying, it's a perfect place to build a mine.
Let's speak about before we go into funding, which is it's a very important there. Permitting, which usually is an issue for most mining projects, so at least.
Okay, permitting is definitely an issue. You hit that for sure. Well, look, we cash depending and all that. We would like to get our mining plan of operations to kick off the permitting process filed by the end of this year. Now that may be a bit tight, but that's what we're looking at. That's going to take a year. We think we can get it done in a year. If you look at what's been said, in the last while was a year to 2 years, but when they were talking a year to 2 years, it was in the former administration, which was pushing a priority on wind turbines and lithium. So now that copper and mining are taking a bit more of a front seat, we would expect about a year on our mining plan of operations. For the environmental, and coming out of the mining plan of operations will determine whether we have to do an EA or an EIS. Now, an EA, environmental assessment, take us a year to 2 years. We think we can get it through in a year because it's such a simple project. It's been permitted in the past, in the mid-90s. I think everybody knows the project because everybody drives over it. Well, it's well known. So that's an EA. An EIS would take longer, a couple years. Again, the way we would sort of work on the risk on that is permit the heap leach first. That keeps things a smaller operation. And then once we're in production on the heap leach, then permit the mill because we've got a 5-year run rate to run on that. So that's the way we would control that and look to move it along. So optimistically, a year for the mining plan of operation and a year for the environmental assessment.
And just as a comparable, if you look at Isabel Pearl down the road, about 25 miles towards Hawthorne, from discovery to pouring gold, it's a heap leach, was a 4-year process. So they're drilling, engineering, permitting, construction, pouring gold, 4 years. So we think it's a reasonable time frame.
When was Isabella Pearl put in production, roughly?
I think about 6 years ago now, 7 years ago now. It's already in production.
It's not
okay. So essentially, the permitting process for Isabella. So how long was the permitting process all in all for Isabella Pearl?
From what I understand, it was under 2 years.
Okay. Oh, yeah, that's good. Is that also on BLM land?
Yeah.
Yeah.
First of all, you need the mine plan of operations before you can start the EA or the environmental process, or can you start it?
The way it works, you do the mining plan of operations, and that determines whether you have the EA or EIS route that you go. So you're kicking things off with that mining plan of operation. That really sets the tone for going forward.
And obviously, this, if it's an EA or an EIS, it changes the timeline quite a bit. So what indications could you give, do you have for that it would be a lot more likely for an EA than an EIS?
My understanding is, if you keep your footprint a bit smaller, you're not dealing with sulfides, because then you have acid generating rock. You're not into the water table. So if we focus on the oxides, we're up higher, we've got a smaller footprint. We think we can, we're not dealing with sulfides. Those are all things that go into it. We think that we will, if we focus on the oxides to start with, the heap leach, that would qualify us for an EA.
What probability would you assign, just to get some sense of your confidence?
Before I give you I think it's a fairly good high probability. I don't know what number, but I'd say a high probability we can get with the EA. But they have these new things that they brought out. There's one thing called the FAST 41 which is expedited permitting now for mining down in the States. So we're looking to see whether we can get within that regime, which would speed things up more. So there are other opportunities to speed things up because, there's the demand for copper. The other thing we're looking at Ken's looking at is, do we have any of these lighter rare earths?
Yeah.
And if, when we assay, typically it's about a 50 element suite of 50, right?
40.
40 elements that we're assaying for on a typical drill program. So now we're running further assays to see if we have any of these lighter rare earths. And if we do, well, then that would help our permitting because of the demand for rare earths and copper. So we're going to use the copper, and if we have some rare earths, whatever we have, to get ourselves into that more expedited permitting regime.
Okay, excellent. And you mentioned that it's cost dependent or cash dependent when you can file the mine plan operations. What kind of cost are we talking here to?
Look at what we'd like to do, just in general, is we expect to be raising money this fall in the $2 to $3 million range, and that would be sufficient funds to fund what we need for drilling and for getting the mining plan of operations in. The engineering's been done because we're going to use all our layouts from the PEA. We've done a lot of work on that already, so we have all the layouts done in there. It's just putting it into the forms and getting it filed.
You will, in other words, file it by the end of the year, or at the minimum in Q1, at latest in Q1 next year.
That's our push. It's up to us to get that pushed through to get it done.
There's no real, field work that needs to be done to file the.
From what we're aware, and we've had some conversations, it's a question of having the funding to put it all together and file it. We've collected a fair bit of data already.
And it cost a few $100,000.
Well, no one gives you an exact quote, but yes. Yeah, we're expecting it in that range.
So then let's talk what's most pressing here is that, so you need $15 million US at least, maybe a few million more. You got G&A, a little additional drilling, etc., to get to a feasibility study. How do you plan to fund that?
Well, we think it's actually 15 or less, but you can throw a number out there, but we think it's 15 or less. Look at that. One thing we're looking at is selling a royalty. We think a 2% NSR on the project should be good for 12 to 15 million, and that we think it's good for the feasibility study costs. We think we can sell a 2% NSR, so that's something. Because it comes down to how do you fund it is a question of dilution, right? You either equity, you're not really going to be able to fund it with debt, so it's equity or royalty. Royalties are out there. We've had some discussions as well, but in the past. There was some, so we could focus on the royalty. But on the other hand, if we were to get a strategic investor in, validate what we're doing, we should see a pop in the share price. And then maybe we look at some equity. Maybe it's a 1% royalty to sell and then equity. Because I think if we sold a 1% royalty and could pull in $7 or $8 million for that 1%, all of a sudden we've got the cash to get things going, everything else, and people can see that. And then we should get a lift in our share price. And then it's a question, do you sell another 1% royalty or do you sell some equity? You just have to look to where the dilution is the least.
First of all, let's speak about either way. You will most likely do a small raise, as I said, 2 to 3 million, Canadian dollars to drill, get going, file the mine plan of operations, and maybe do some early work on the feasibility study. And you will raise that this fall. What kind of, I guess 2 to 3 million. You wouldn't, if your share price continue, maybe this in the, 20, you can raise at 20 cents. Would you consider bringing in more?
Well, look at you. You never say no. If there's a lot of interest, we'd look at it. Look at. you have to see the particular situation. What's your price at? What's the dilution, and the trade off? What's the benefit for what can we do with the extra cash? Does it outweigh the dilution? And yeah, look, it would be hard to say no, because we have lots of things we can do to move the company forward quicker with that extra cash.
I mean, essentially, unless you participate, I mean, you're the largest shareholder besides Waterton. So it's really up to what dilution that you think is acceptable to your own positions. Which is good though, because that means that you have to be careful with dilution.
Yeah, look, and you know, there's it's a trade-off again, because okay, we don't want to dilute. On the other hand, you're not doing anything, and if you want to move forward, you have to dilute some. So it's a trade-off. What's the balance? And that's what we think about, and what we'll look at, and how best.
What discussions do you have with mining? Because by now, I guess a lot of mid-tier producers are aware of Gabbs.
Well, we've got our Beaver Creek schedules, you know, which is September 9th through 12th, the Precious Metals Beaver Creek Conference. Our schedule's filling up. We have quite a number of sort of mid-tier meetings.
What kind of companies are interested in a project like Gabbs?
Well, it's an ideal company for a mid-tier gold producer, right? So any mid-tier gold producer should, you know, if we were running them, they'd be looking at Gabbs.
Yeah.
Do you, if you raise between 3 to 4 million Canadian, do you need to have the royalty or a strategic investor, or get a larger cash injection before kicking off the feasibility study?
No, well, look, we could do some of the work. We could kick off, like, maybe do some of the metallurgy or some of the other work. Yeah, we can break it up, and just to get things moving, look at the longer lead items within the feasibility, and maybe get cracking on those with cash. That's where we could put it to work effectively.
But ideally, a strategic would come in as part of that financing. So we'd get the validation plus the results from drilling to drive the stock, which might, in an ideal world where our stock's moving up, and so we don't need to sell a royalty. That's in an ideal world where the market gives us credit.
But so on the royalty side, I mean, are you in any advanced discussion on that, or is that? I mean, I guess all have been waiting for the metallurgy, which is kind of coming out now.
Yeah, exactly. Everything's been on hold, waiting for metallurgy, and then we'll get the PEA update, and then we'll go back out and be a little more aggressive on looking to move forward.
So, if you know that you won't get a strategic in this upcoming race, will you push hard on as soon as possible getting a royalty deal in place?
It depends how our conversations go at Beaver Creek. I think will be determinative of how we push. Because even if the strategic doesn't come in right with this financing, if they come in with it, if we have a good feeling that they'll come within a month or two, then it's worth waiting for that. We'll still talk to royalty companies in the interim and run parallel processes, but I think the strategic route would be beneficial for everyone.
That's good. And can you give some sense? If you say, for simplicity, if you say like 1% NSR on Gabbs, what sort of a minimum, a minimum price that you would accept in US dollars?
Well, it's
hard.
Top secret.
Yeah. Yeah.
It's hard to say what your minimum price is until somebody's in front of you with a check, and you say, "Well, yeah." So it's hard to say right now. What would we say? 5, 6?
Oh yeah. I mean, it'd be really hard to let it go for less than that, and I'm not even certain that's my minimum.
Yeah,
I think 7 to 8. Closer to 10, to be honest. You just look at the numbers, you look at the fundamentals on metal prices, you look at everything about the project.
Could you outline some pathways to how would you finance? Say it's a $400 million Capex.
Oh, that's not hard. When we financed Bruce Jack, what we did is we went out, we ran our own process. It didn't have any bankers involved. We ended up with private equity. We had debt. It's expensive, but it lets you get built. So we had debt with tied to an offtake agreement with a stream that had 100% buyback, but with a bit of equity, and we raised $540 million on that to put as our main financing to get Bruce Jack going. Then we piled on about 120 in equity and another 100 with convert. So you look at what's available, but private equity's out there. They've got money. It's expensive money, but it lets you get going. If bank financing, the problem with bank financing, it takes you so long to go through the hoops. By the time you get it financed, you could probably be in production if you're paying more for the money. So, yeah. So there's options, lots of options.
And so ultimately, also, do you see yourself, eventually building Gabbs, or do you think it's a lot more likely that someone else will build it?
Well, look, the way we look at things, and it was the same with Bruce Jack, you push things along, and if somebody comes along and says, we're willing to buy that, and they're willing to pay a price that everybody says, yeah, that's a good price for us to just say, okay, you take all the risk going forward. We're not going to argue with that, but if no one comes along, we'll just keep pushing forward and build a mine.
In other words, I mean, if you have the financial capabilities to do so, it's not out of the question that you actually would go ahead and build it.
Look at it; it's a simple mine to build. There's nothing complicated about Gabbs. Bruce Jack was,
it was work,
and we had a guy that came in partway through to just take a look. We had him come in and take a look, and he built a lot of mines in remote places, and he said that was the toughest build he'd ever seen. So, with Gabbs, we're not expecting big issues with construction at Gabbs.
That's great. And so, could you summarize the catalyst for the coming 12 months?
Well, looking ahead for the next, say, 6 months, we're going to get final metallurgy out. We're going to PEA update out. We should get our water permit within that period, so we're in Q3 here. Drill results going from starting to drill. If we can get going in late October, we should see drill results. Yeah. Later in November through into the next year. I expect we'll see a resource update out based on this drilling. That would probably take us into spring. Mm-hmm. Yeah. Mining plan of operations filed. Those are the big items, and and somewhere in there's a possibility of either a strategic or a royalty sale to really, give us that leap forward to get through feasibility and get to the point where we're just waiting to break ground.
So where do you envision P2 Gold in 2 years from now?
2 years from now, we should be well on our way to getting in production. We should be well into feasibility, if not out of feasibility. Well, 2 years from now, I'd like to say we're out of feasibility. We've got our mining plan of operations. We've got an idea when our EA is going to be approved for the mining, and we're lining up. We're in detailed engineering, and we're lining up contractors to break ground once the EA is approved. So that's where we'd like to be 2 years from now. It's a push, but if you don't set targets for yourself, you don't get there.